All right, today we're jumping into a real economic mystery. It's all about a country that, for decades, has been in this strange position of selling way more stuff to the world than it buys back. We're talking about Russia. And, as you'll see, the reason for its export success isn't at all what you might think.
So yeah, that's the big question, right? For a very long time, Russia has maintained this massive, persistent surplus in its trade with other countries. And economists have been digging into why that is. And the answer tells us something really fascinating about how global trade actually works.
And we're not talking small potatoes here. I mean, just look at these numbers. Between 1994 and 2016, Russia's trade balance averaged a wild 8.9% of its entire GDP. And its current account, which is an even broader measure, was also in a massive surplus. This kind of imbalance, sticking around for this long, is pretty unusual, and it really begs for an explanation.
Okay, so to crack this puzzle, we've got to start with the basics. What's the standard playbook countries use when they want to boost their exports? What are the usual tricks of the trade for any government trying to sell more of its goods to the rest of the world? So, the first tool in the toolbox, the go-to move, is something called price competitiveness. It's actually a pretty simple idea. You make your money cheaper, so your products get cheaper for everybody else to buy. When they're cheaper, more people buy them, and voila, your exports shoot up. So, when you boil it all down, the standard thinking says there are two main ways to boost your exports. Number one, make your stuff cheaper by making your currency weaker. And number two, just hope that your customers get richer. Right? I mean, when the economies of the countries you trade with are booming, they just naturally buy more of everything, and that includes your exports. Seems pretty straightforward, right? Well, yeah. But the whole situation with Russia kind of throws a wrench in that simple story.
And the first clue that something else is going on here actually comes from a totally different part of the world and a completely different kind of economy. We're talking about the high-tech exporters over in the Eurozone.
I mean, think about it. If you're Germany or the Netherlands, you're on the euro. You can't just wake up one day and decide to devalue your own currency to sell more cars or tulips. It's a shared currency. So that forced economists to get creative and look for other clues besides price and income. And what they found was that the type of stuff a country sells, its export composition, was incredibly important. Specifically, the percentage of high-tech goods. And what they found was really interesting. The researchers saw this clear connection. The more high-tech stuff a country exported, the better its overall export numbers looked. But why? What's so special about high-tech goods? And the answer to that why comes down to a really key economic idea: inelastic demand. All it means is that people are going to keep buying a product, even if the price wiggles up or down. You know, if Apple needs a very specific, super advanced chip to build the next iPhone, it's going to buy that chip, even if the price fluctuates a bit. The demand is stable. It's inelastic. Okay, so what does all this have to do with Russia? Well, that concept we just talked about, inelastic demand, that's the key that's going to unlock this whole mystery. See, Russia might not be known for exporting tons of high-tech gadgets, but it does export something else that the world absolutely has to have.
So the real connection here isn't about trying to compare a microchip to a barrel of oil. It's about figuring out the one powerful economic trait that they both share.
And there it is. They both have what's called inelastic demand. Just like a factory needs a very specific microchip, a country needs energy to run, to power its homes, its factories, its cars. So the demand for oil and gas, especially in the short run, doesn't really budge all that much when the price changes. It's a fundamental must-have good. And how big of a deal is this for Russia? Huge. For 20 years, a full one-third of what it sold to its biggest trading partners was just two things: crude oil and natural gas. This isn't just one part of its export economy. For all intents and purposes, it is its export economy. Okay, so this sets up a really simple hypothesis, right? Just like those high-tech goods in Europe, having a bigger slice of your export pie made up of these inelastic energy products should directly lead to higher total exports for Russia. The more of these must-have goods you sell, the more you should sell overall. Seems totally logical. But when the researchers actually ran the numbers, something really weird happened. And this is where our little economic detective story gets a major plot twist. The first simple look at the data seemed to prove the idea right.
But when researchers dug just a tiny bit deeper, the whole picture just flipped upside down.
So check out this table. The first, really simple model, it showed a positive effect, exactly what you'd expect. But then, when they added more complexity, when they looked at how all these different things interact, suddenly the direct effect of having a ton of oil and gas exports flipped to negative. It actually looked like it was hurting total exports.
So, what on earth is going on? How can this be happening? How can having more oil and gas be both good and bad for exports at the same time? It feels like a total contradiction. The answer, it turns out, isn't about the direct push and pull, but about a much sneakier and way more powerful economic force.
And that brings us to the idea of indirect effects. Think of it like this. It's not pushing the final number up or down itself. Instead, it's like a master volume knob, turning up or turning down the power of all the other things that are in play. It changes the rules of the entire game. And that brings us to the real engine driving Russia's export machine. It's not that selling oil and gas directly adds up to a bigger number. No, it's about how the dominance of oil and gas completely rewires the whole export equation. Okay, so here's the big reveal. Having a huge chunk of your exports be oil and gas does two really important things. First, it makes your export numbers super sensitive to your customers getting richer. So when their economies grow, your exports grow even faster. But second, and this is the really critical part, it makes your exports almost totally immune to changes in your currency's value. That whole playbook of weaken your currency to sell more stuff, it just doesn't work anymore. It's off the table. And, this is a really big deal for policymakers. That go-to move for fixing a trade problem, playing with your currency, it might be totally useless for an economy built like Russia's. You can't fix a problem if you don't even understand how the machine works. The missing piece of the puzzle, it turns out, is always about the specific cocktail of goods a country sells to the world. The author of the paper we're looking at, Edgar Tovar Garcia, he really nails it. He says the real clue to export performance isn't whether you're high-tech or resource-rich. It's just about having a high share of products that your customers simply can't do without. Those products with inelastic demand. That's the secret sauce. And that just leaves us with this one last thought to chew on. We all tend to rely on these simple textbook rules of economics. But as this whole case shows, the real world is so much messier and more interesting. I mean, if the standard economic playbook can be so wrong in this one case, it really makes you wonder what other rules of economics that we take for granted are just waiting to be proven wrong. It's a puzzle worth thinking about.